Hello everybody, my name is Pranay. Today we are going to understand about equity market. So it is very important, and after post-COVID crisis, people have become more aware about equity, stock market. They have started more investments, started doing more investments into equity market and share market basically. So we are going to discuss about equity market, the basic. So it will be a part of a series where we are going to understand what equity market is, what is the basic. Then we are going to understand how we can research equity. We can find out good stocks. So for that, we are going to discuss about equity research. And within that equity research, we are going to discuss about fundamentals, technicals, financial modeling. All that will be part of a sequence. So let's start a beginner's guide on equity market. Now, as today's agenda would we will understanding what equity market is, you know, the platforms where we can do the trading and investments. Why should we learn, equity market as a student or as a working professional? Why should we learn? And we are going to understand how in the short term and the long run, what is the difference between the wealth creation means? Can we create wealth in the short term or in the long run? What are the basic tools by using that we can invest in equity market? So we're going to discuss that thing as well. And guys, before I proceed further, I would like to give a small disclaimer over here that whatever we are going to discuss in today's class or the next coming classes of equity market or equity research, it will be just for the sake of educational purposes, should not be used as a advice for investments or trading. So it's a humble request. And why we should be learning this thing? Guys, in equity, there is so much to learn, so much to learn. People just start their investments without having the knowledge and they lose a lot of money. So my take on this is that we should learn more. Once we have good learning, then we can start application of that learning into equity market so that we don't lose our money. So it is very important to understand how wise and all the tools of equity market. So we need to understand these things. This is very important basic. Now let's start from equity market. Now what is equity market? Why it is called equity market? uh, you might have heard the term capital market as well. So let's say equity. Equity means giving some equal rights, right? So what equal rights will be distributed? So term equity came from some equal rights. So equal right means some kind of ownership which is given. Now let's understand in a simple way. Now within this equity market, there are two further markets: primary market and secondary market. So this will make things bit simpler for you. Now, just imagine, guys, for example, you are watching this video, right? And you are starting a business. You need money, right? So where you can take the money from? You have a good idea. All you need is money, and money to start a business. So from where you can take that money? So step number one, you could go to a father, mother, parents, relatives, friends, and you can take money from them. So if they are rich, if they have good amount of money, they will help you out. Option number two, you can go to bank and take loan from the bank. So this is option number two. But in bank, you have to return the money and you have to pay at least 10, 12, 13, 14% return on interest, right? We have to return the money. The third thing is that you go to the people who already have the money and who are willing to invest money to some business, or who have some surplus amount of money and who are willing to use that money somewhere as an investment tool. So you can go to a businessman, or you can go to public as well, because public is also having money, maybe not that much amount of money, but still they do have some amount of money. So you can go to these people and ask either public or a, a rich, big shot businessman for some money. And in return, what you would be giving? You would be giving some ownership of the company. But what will be the benefit over here? The benefit would be that you will not have to return that money until and unless that money is being demanded, until and unless you are going bankrupt, until and unless you know you are intentionally giving the money in terms of profit sharing. Now let's make it more simpler, guys. Now there are two types of markets within this equity, that is primary market and secondary market. So this is very important as such. Now I want to ask a question from you that, for example, today you purchased a share of Reliance, you purchased a share of TCS, you purchased a share of uh, HUL, any company for that regard. Now, where that money is going, to whom that money is going? Is it going to the stock market? Is it going to the company? Now, think and answer. Means if you are buying a share today, where that money is going? To the share, to the shareholder, to the company owner, to the stock market, or to the broker, I would say. Like broker could be Upstock, Zerodha, SBI, SDFC. There's so many brokers in between. Think and reply. So answer would be, the money would be going from a buyer to a seller, from one shareholder to another shareholder. Means if today you are buying a share of Reliance, someone on another side would be selling a share as well. So there are two party system, two stakeholders, buyer and seller. So the money is not going to Reliance, money is not going to TCS, money is not going to the company. Money is being exchanged, or there is a transaction that takes place between two people, buyer and seller of the share. So how come it is possible that money is going to a company? Means how company is related to this transaction then? Good question, right? So let's start from the very beginning of this thing. Primary market. As I started my class with a story that you were a businessman and you needed money. For the very first time, you needed money. You need 1 crore rupee to start a business. Now, you could have either gone to public, and if public can give you 1 rupee each, and we are 150 crore citizens staying in India, country like India, so you will be sitting at the corpus of 150 crore rupee. Even if you manage to take 1 rupee from the pockets of all the citizens of India, just imagine that much amount of money, and 1 rupee will not be, heavy in my pocket as well. So it's easy for me as well to give you money. So you are raising money for the very first time. This is example number one. Let's take example number two. You are going to a big businessman for that 1 crore rupee. And you took that money from a big businessman like Mr. Ratan Tata, like anybody for that, from Mr. Ambani or from Birla's. You go there, you pitch, and you take the money. So that first time taking the money is called as primary market. And this money goes to the businessman, to the company. Now, how it is relevant in the practical example? Now, you might have heard the terms IPOs. So whenever IPOs are issued, so company needs money, they go to public and they take money from the public and they raise huge amount of money from the public. Money is huge, insanely huge, hundreds and hundreds and thousands crores of rupees. That money goes to the public. So that is the first time money is being issued, money is being raised against IPOs. So this is what we call as primary market. When the money was issued, when the money is raised for the very first time against the issues of IPOs, so this money goes to the company, regardless of any company. This money will go to the businessman who was starting a business. This money will go to the company who wanted some money for the expansion. Now, secondary market, what happens in secondary market is that shares which were allotted, right? That will keep changing the hands. That will keep changing the ownership. Means today I am the owner of one share. I will sell it to you. You will sell it to next person, and this transaction will keep going on. So this money in secondary market will not go to the company. This money will be, there is a transaction that will take place between the buyer and the seller. Who is the buyer? Shareholder. Who is the seller? Shareholder. One person is selling, another person is buying. So there is a difference. Primary market money goes to the company, goes to the businessman for expansion. Could be starting a business, depending upon which stage of business he is raising the money. Secondary market is when the second hand products are being sold. Now let's give one more example on this. I am buying this iPhone for the very first time, right? So I will buy this iPhone from Apple store. So I will pay 1 lakh rupee. That money will go to Apple, right? So directly that money is going to Apple, right? Now I am buying the same iPhone in the secondary market, in the second-hand market, or in OLX or any platform which is selling like Cashify, who is selling second-hand products. So that money, when I am buying the same product, but in second-hand rate or in second-hand market, so that money I will be paying to the seller, not to the company. That money will not go to the Apple. That money will go to the person who's selling his iPhone. If today I am selling my iPhone to you, you will be paying that money to me, not to Apple. So Apple had received its money for the very first time when it was sold for the very first time, first hand product. Then my phone will keep changing the hands from me to you, to your family members. So this is how it will keep floating. But the money will keep exchanging its hands between these people, but not between the company and the buyer. So I hope you got the point. So primary market is the market for the very first time when the company is raising the money. It is a very important aspect, a very important time when the company is raising the money, and that is a very important, you can say, timeline for that company. It can't go wrong in that. So they are raising the funds for the very first time. In secondary market, what is happening? There are second-hand products being sold, second-hand securities being sold. In this case, the shares are exchanging hands from one to another to another. This is how it works. So in IPO, the money goes to the company. And in normal stocks, the money just exchange the buyers and sellers and buyers and sellers. It's just a transaction of the same old product. I hope this is clear. We can invest in both IPOs and we can invest in both shares as well. So these both are a good investment tool. So we are going to discuss in the further classes. So these were few stakeholders which are involved. Now, what are another stakeholders which are involved in equity market or stock market? So why the word equity was given? Because I am sharing my ownership. So I am sharing some equal rights or equity to other people. So this is how equity word came. Why I sometimes word capital market is used, because I am raising capital from here. So that capital can be used for expansion. That capital can be used for buying, machineries, anything for the growth of the business. So that is why the word capital could be used over here. Now, one more thing, guys. As I told you, once I will be raising the money, I may not, or it is not mandated that I have to return it back. That is the best benefit a equity market can deliver to a person, to a businessman. Just imagine you are going to start a company. You have 1 crore rupee which were raised from public. You don't need to give it back. That is your money. I hope it is clear to you. So this is called as IPO. When you took money from people, on contrary, what you have to do, you have to give your financial statements to the public. You have to show that financial statements every quarter, firstly. Second, your ownership will go down. That we are going to discuss in the coming classes, how the management takes place when the ownership is diluted. What happens when 50%, 51%, and what happens when the stakeholders are more than 50%, how that those companies perform. That we are going to discuss in the coming classes. But right now, just imagine one thing. Earlier, you were the owner, you were the only decision maker. But if you have so many owners, so many people involved, so you can't take decisions so easily. So for every small decision, you have to do voting. Voting means, for example, you are taking a decision that what should be done to expect for the expansion of the company. You can't take the straight away decision. You have to take permission of the stakeholders. This is what happened with the Vaijus. Everyone is blaming Mr. Vaiju that he took wrong decisions. But guys, the thing was that there were shareholders and all the decisions were made by taking the votes only. So it's not one person's decision, decision of so many people. Now, these are the stakeholders of stock market, equity market, buyers and sellers, because I am buying, you are selling, or I am selling, you are buying. Brokers. Brokers are those players who organize this thing and who makes things easy. They provide you platform, they provide you technology and makes things quite easy. For example, Zerodha, Upstokes, SBI, HDFC, Axis Bank, all these are stock, brokers basically. They provide you the platform where you can sell and buy things easily. Otherwise, how would I meet you? Otherwise, how would you meet? When I'm staying in another state, you're staying in another state. How will we meet? How will buyer and seller will meet? So brokers make it easy. And then there are regulators as well, because such huge transaction is taking place throughout the country. There must be someone who could regulate, who could systemize the things. So government comes into play. So it is SEBI over here. SEBI keeps an eye on all the transactions. SEBI keeps note of all the transactions, any fraudulent activities taking place or not. Everything is going perfectly fine because money of citizens are being involved. Being a businessman, I am taking money from all of you, right? So that is why regulators are very important. I can misuse that money as well. To protect the money, regulators are there. Now, next question is, sir, everything is okay, but you might have seen, for example, let me show you a small diagram. This is a diagram of a share Bajaj Finance. Sometimes it is going up, down, up, down, up, down. We are going to discuss this in technical charts as well. We are going to discuss how these all technical charts work. But you might have seen sometimes the share price is going up, sometimes going down, sometimes up, sometimes going down. Who is regulating this? How the share price is going up, how the share price is going down, and why it is happening. We need to understand this thing as well, right? So, guys, one very important concept of economics and macroeconomics is demand and supply. If I allot, very less amount of things amongst you, means, for example, let's take example of Rolex. Rolex is so costly because they produce only 10, 20 watches in 1 year. Just imagine 10, 20 watches. And the supply is so low, so constricted that so many rich people demand for it. And once the demand goes very high, guys, the price goes high. As simple as that. Similarly, same happens in stock market. If the demand of share goes up, people will try to buy it more. And why they will buy it more? Because they expect the prices will go further higher and they will make profits out of that because it is just a transaction taking place. In secondary market, as I had discussed with you, in secondary market, we are just buying the things. Let's give you one more example over here. I purchased, for example, this phone last year, for example, at the cost of 85,000, just for an example. And all of a sudden, after 2 months, Apple announced a software that will include AI. And Apple increased the prices of the phone to 85,000 to 2 lakhs. Now you will wonder that something special is, happening. And now, even I'm a smart guy, what I will do, instead of 85,000, I will sell it to you at 95,000. Now, you will think that Apple is a good company. Even if I buy second hand at higher price, it will offer you some value, right? Same happens with Rolex watches. It has a very good secondary market. Same happens with all the luxury cars like Audi, Ferrari. All these cars have very good secondary markets. So if the purchasing power, if the and same happens with a recent example of these shoes as well. The Jordans. They have also very good secondary market. So people buy at less price and they sell it second hand at higher prices. So this is why demand and supply comes into play. So demand and supply is the reason behind which all the stock prices can sometimes go up and down. And demand and supply can be linked with multiple factors: growth, emotions, growth of the company, growth of the country, growth of the world, macroeconomics, microeconomics, both. So, and emotions of the people, customer behavior. So all these factors come into play and they will change and manipulate the demand and supply. And this is why the prices will go up and down, depending upon the on the what kind of demand it is. So instead of Bajaj Finance, just imagine this as a Rolex watch. So Rolex watch price can go down depending upon the demand. If the Rolex manufacture very less amount of watches this year, only two watches, so demand will go high this time because only two watches were prepared. So people will buy from second hand market. So prices will go up. So if Rolex tomorrow starts preparing, start doing mass manufacturing, mass production, then the supply will increase, the prices will also go down. So this is how the entire concept of prices, it works in the stock market. I hope this is clear to everybody. Now, Trading mechanism, I told you, how the stock market, how I can buy a share. So for that, I need to have an account with a broker, and that broker is registered with SEBI. So I can, nowadays everyone is a broker. SBI also started its own facility. Axis Bank, HDFC, Zerodha was also there. Upstocks is also there. Grow app is also there. It's not an advertisement video. Just these are just examples. So these things will make things easy for you for the transactions. You will be, it will become very easy for you, from where to buy. Earlier, guys, just imagine. I'll give you a very small story for this. During my father days, there were no platforms like Zerodha Upstocks. So it used to take 1 week. He used to go to a broker. That broker was a physical person like me. He used to go to his office. He used to tell him that he wants to buy these stocks. He used to pay money. Then that broker used to buy, and the entire process took at least 10 to 15 days. Just imagine 1 week to 15 days. Today you can buy just in the click of the finger. So that is the important. Everything is becoming online. So there is no need of physical brokers nowadays. In my times, when I started in 2012, we used to call banks that please buy on my behalf. So bank used to buy in my behalf. Now the technology had made the things very simple. So that is the main mechanism. That is the main use of technology, that it made things very very simpler. Now again, you might have heard the term, Sensex fell down, Sensex went up, Nifty fell down, Nifty is doing well nowadays, Nifty is going bullish, Nifty is doing bearish. What is the meaning of these things, Sensex and Nifty? How it works? Now, second question that you should be wondering multiple times: how can I invest in Nifty? How can I invest in Sensex? Now, it's a very good question. Means, can I buy Sensex? You should also, even if I ask you a question, can you buy Sensex? Can you buy Nifty 50? How you can buy Nifty 50? And what exactly is this Sensex and what exactly is the Nifty 50? What is the meaning of these terms? Very important terms and very complicated terms as well. And these are asked in interviews as well multiple times, guys. Now, we'll do it practically, guys. There is a thermometer, that I had made over here. There's an intention behind this, guys. So let's take an example of your class. We are 30 people, for example, in a class. Now, if an auditor comes and asks me, what is the performance of this class? Not one student, of entire class. How and what should I respond to that person? First of all, how should I respond? What should I respond? How can I say that Mr. A is doing good, Mr. B is doing good, but Mr. C is not doing good? Mr. D is also not doing good. It's so complicated, and even he'll go crazy, reading the marks of all 30 students. So being a finance student, what I'll do, I will take average of all 30 students and I will tell, okay, out of 100, this was the average marks my entire class scored. Easy to understand, right? Now, if I am a smart guy, I can do one more thing. I can draft a graph of that. Means I can draft a graph of all 30 students. It will make things more easy. Now, let me tell you, let me show Nifty 50. So guys, this is Nifty 50. So let's come back to the story again. So let's ignore this Nifty 50 for a moment. Let's take this graph as my class students, right? In first term, you scored this marks, second term this, second, third term, fourth term, like this. You are scoring like this. Now let's make it big. Let's make it, times, let's increase the timeline. Starting from nursery, first sec nursery, UKG, LKG, this is how it goes. First class, second class, third class, and this is how it goes. All 30 students are same. This class is just getting promoted to next, and it is getting graduated, right? Now, an auditor can see this graph and analyze how these 30 students are doing. So this graph will make things easy for the auditor to understand what is happening with the class. Now, this is what I want to say. This graph is not an indicator of one student. It is indicator of all the 30 students of the class. including the best, including the least performing, including the most dynamic, including the introverts. All the students are included. So it will give a picture that if it is going up, it means the class is doing good. If it starts going down, it means the entire class average is not doing good. So there is a concept of of average over here. So I took average of all the class students and I made this like this. So it is a thermometer basically of all the people involved. Now, how it is relevant in stock market? So in stock market, it is very there are so many companies registered in stock market. Even you can also register your company in stock market. You just have to follow a few regulations, and you can also get yourself registered in the stock market. But how it will work, right? The thing is that you were a businessman, you needed money from people. You will go to stock market, ask them, give us permission to raise funds from people. They will give you permission, and you are also registered in stock market. But guys, for a stock market, for government of India, there must be some parameter to check how the industries of the country doing. The same example, when auditor came to my class, I was a teacher, you were 30 students, right? So just seeing this graph, you get to know that whether all the students are doing good or all the students are doing bad. Same case happens with indices. Indices is a, it is a graph, it is a representation of all the top performing companies of the country. And this of the country of any country, I would say. For example, in India, we have two indices. One is SENSEX, another is NIFTY 50. SENSEX is for BSE, Bombay Stock Exchange, and NIFTY is for National Stock Exchange. So all the companies who are registered under BSE, they will be, they will be having a parameter that is SENSEX, and NIFTY is the parameter of all the top performing companies of NIFTY, basically, of National Stock Exchange. Now, why this is important and what it represents for a country, how it is represented means what it can represent in a country. We are studying equity, we are studying economics as well. Both the things will come, in a combination. Investment banking is a subject where all the subjects will get combined. So if I ask you a question, if Nifty is doing good, what does it mean? What impact it has on employment? What impact it has on production, manufacturing, job creation, currency, growth of the nation? What are the impacts and how it is impacting the countries? How it is impacting the growth of the nation? Let's see. Now, every country is having a index. S&P 500, USA, Nikkei, Japan. There are multiple examples like this. Let's stick to example of India. Now coming back, guys, to the story again. Now out of those 30 students in my class, if I make up a graph of top performing students, means top 10 students of my class, that could also be made, means for the better understanding. So there are thousands and thousands of the companies which are registered under Bombay Stock Exchange and National Stock Exchange, but top 50 companies are included in Nifty. So that is why these are the parameters of top 50 companies in a country, within a country. So this is a parameter, this is the representation of top 50 companies, average of all top 50 companies, how they are performing in a country basically. Now guys, if the top performing companies are doing good, for example, if the graph is going good, it means maybe it's a possibility that all the sectors, all the economy is doing good. Companies are doing good, graph is going upward, good employment, good earnings, people are also doing good, poverty rate is less, it means people are spending more money, it means country is also growing. So this could be an outcome of this. All these things I can perceive out of this. But this graph is not just a graph. This graph is the representation of the entire economy, how the businesses are doing, the best companies. Now, let me ask you one very, very simple question. In my class, if 30 students were there, 10 students were the toppers, top 10. If top 10 students starts declining in their marks, so it's a normal perception that what would happen to the poor students? They will also decline. Their marks will also decline. If the toppers are not performing, how would I expect that the poor students are not doing good? Same case, if the top companies are not performing good, how can I expect the normal companies and small companies will also do good? So this is a good representation what is happening in an economy, guys. What is employment? What is growth? What is, you can say, uh, what is the production rate? How the industries are doing? How are the interest rates in the market? That is also dependent. That we are going to do in the business cycle. We are going to discuss that in the next class. So this one graph is a representation of the entire economy. I hope this is clear to everybody. So that is why these indices represents the trends of the market, and they tell investors how the overall health is going on in that economy. Now, if I ask you a question, you are going to invest in Africa, you are going to invest in America, you're going to invest in European countries. So first thing that you should be seeing is how the index is doing. If the index is doing good, there could be a perception that the entire country's economy is well. If it is falling down, it means something wrong is happening in the economy. First perception. Second perception, you can say if you're going to start a business, you can say this thing. What is the environment for the business right now? So this thing can give you an outcome, that perception that how the businesses of the country is doing. If you are a school student, if you are a college student, you are planning to do something in a specific sector. So you can see how the job condition is there in the market. This can also tell the inflation and the money supply. If it is going up, it means people are investing a lot of money. They are having a lot of money right now. It means money supply is very high. Interest rates are liberal. It means inflation is high. So see, just one thing can tell so many things. And guys, there are multiple indices. There are so many indices as well in the country. So that will be a homework, that what are the indices in India and what they represent. For example, there is an index of bank as well, Nifty Bank. So how the banks of the country are doing, we will get to know. If something wrong happens, you will immediately get to see the repercussions over there in this technical graph. I hope this is clear. So coming back to Nifty. Now, guys, one more thing that should be coming into mind. Sir, okay, we got the point that these are top performing companies of the country, and if they do good, country will be doing good. But which companies are into this? Which companies of India are Nifty 50 companies? Second question that should be coming into mind: are these companies fixed? Means, are these top 50 companies, for example, in Nifty 50, will they always stay constant? Or new companies can anytime come in, or any existing company can go out? So what do you think? And I will relate it with the story of the class. Can a topper student of a class fail in exams? Absolutely yes. If he stops studying, if he do something wrong, if he fall in a bad habit, if something happens to his health or in his family, he may stop performing. So from top position, he may fall down. Same happens with the companies. Anytime company can exit, and anytime a new company can come in. So let me show you. So this is a chart of top 50 companies, guys. Very, very important. Now, what I want to say, this is the chart. These are top companies: Reliance, TCS, SDFC, HUL. You can have a look at this. Pause the screen and you can have the look at top 50 companies. These top 50 companies, the average of these top 50 companies using the formulas. So we are just understanding the concept. We will go to the formulas in the next coming classes. The average of the performance of these 50 companies is represented in the Nifty 50. Firstly. Secondly, can any company exit any point of time and new company can come in? Absolutely. If some another company become the top 50 and they start performing good, they can anytime enter. And if any one of these company gives some poor performance, they can be removed out of this. So that is decided by SEBI itself. Now, sector representation, what does it mean? It means from which sector which company is having what kind of weightage. So financial companies, financial services companies, financial banks, they are having 37% weightage. Means in these 50 companies, more weightage is given to the banking sector. Then comes energy, then comes IT, and this is how the entire representation of all the sectors. That's why I was saying it is a representation of the entire economy. You can say You can see over here financial services, energy, IT, automobile, construction. If something happens to construction sector, definitely it is going to impact in Nifty. If something happens to IT sector, definitely it's going to impact. Same if something happens to financial sector, it will have more impact because more weightage is given to them. I hope this is clear to everybody. So fertilizers and pesticides is given less weightage over here. The reason behind is as we move from the agriculture community to the service sector and manufacturing community, the weightage of agriculture product it decreases basically. So I hope this is clear to everybody. So these are the companies which are having higher weightage. So you can ask, sir, can these weightages be changed? Absolutely, depending upon the performance of the companies. So this is how the entire process works, guys. So a Nifty 50 are the is the representation of the top performing companies of a country, of our country basically. Same happens. Indexes can be of any sector. Indexes can represent any country as well. So in Nifty 50, we are giving top 50 companies of our country basically. Now, your question should come in your mind, sir, everything is fine now. Can we invest in index? Can we invest in indices? Is it a possibility? So, guys, if I tell you, uh, there are multiple ways, but you can't buy Nifty 50 directly. The way you buy stocks and you keep holding those stocks for a long period of time means, for example, if I buy Reliance today, and I can keep that Reliance share with myself for next 50 years, 60 years. Same case can't be done in indices. I can't buy Nifty 50 today and I can't keep holding Nifty 50 for next 10, 20, 30 years and I can't give that to my child or my wife. I can't transfer it. So there are another ways of investing in index. Way number one, easiest way, I will let you know. That is, why not buy these top 50 company shares with the same proportion level? Let me reiterate myself. If you are having 1 lakh rupee and you want to buy top performing companies, of the country, instead of, betting in bad companies, lower companies, why don't you invest in top 5 companies? Divide that 1 lakh rupee 20,000 in each company. Reliance, TCS, SDFC, Infosys. Good way of investing. These companies are the best performing companies. If you ask me, sir, if uh, so if I ask you a question, if there are 5 students who always top in the class, who always comes first in the class, right? Why don't you bet on those students instead of betting in those students who sometimes perform good, sometimes don't? So similarly, these are the toppers of the country. So why not to invest in these countries, in these companies? So what I want to say, practically, if I tell you, you can invest your money, you can invest your money, you can diversify, and you can buy the shares of these companies individually. One way of investing. Now you would ask, sir, it will require a lot of money. Absolutely. This is a drawback, that it will require a lot of money. So you can buy in the weightage, in the similar weightage, that you can invest more in financial sector, energy sector, IT sector. This is how it goes. Now, if you are investing like this, the thing is that you can invest in the sector. It means more money is flooding in these sectors. Financial sectors means more people are buying. As I told you, if the if it is going up, it also means that money flow is increasing in the society or in the economy. Same case, if this sector is having highest weightage, it means more people invest. So the growth chances are also more because money supply is high. So this is reason number one, you can invest like this individually. But yes, absolutely, there is one small crux over here is that there are chances that you will require more money to invest. Now, what is the second way? Second way is buy a mutual fund. Now, we are going to discuss mutual fund in the coming classes, but you can buy a mutual fund. Over there, you just have to do a SIP or lump sum of 500 rupee. And if you have 10,000, 20,000 rupee, you can do lump sum amount of investments. So you can buy index mutual funds. So what these mutual funds do, they take your money, collect money from public, and they invest in these companies individually. In the same way, the way you would have done if you would have some money. But if you don't have money, you have only five. You can't buy these all companies with 500 rupee or 100 rupee note. But still you want to invest in all these companies with 500 rupee, 1000 or 2000 rupee, you can buy a mutual fund, index mutual funds. So that is second way. And if you ask me, sir, what is the difference between investing in a normal share? Means, for example, if you buy a share of Reliance and if you invest in mutual funds, right? The thing is that in Reliance, chances are there something wrong can happen. Your money can get lost. Mutual funds are less risky. Equity directly is more risky. Secondly, you can ask one more thing, sir, which will give more returns? These 50 companies or small companies? Chances are there small companies can give you more returns, but these companies will give you a stable return. May not be very, very high, but a stable return, and chances are there these are the toppers of the class. They will never fail. So you will get at least some return. You may not get losses at least. Your money will not become zero. Though that could also be a case. For example, Yes Bank, there were examples like Kingfisher, there were examples like Reliance Communications that your money also becomes negative, but chances are very rare. For that, you need to have good knowledge. So for that, we are going to discuss in equity research. Now, next is guys ETFs. Now, what are ETFs? Let me Nifty Bs. So you can see just 200 rupee, you can buy a ETF. Now, what is an ETF? ETF is just like a mutual fund, just like a asset management company, but which is registered in stock exchange. So the graph will move with just proportionate level with just equal to the Nifty 50. That is why it is Nifty B. So if the Nifty 50 is going up, this will also go up. If Nifty 50 is going down, this will also go down. So if you have only 200 rupee, just buy this. So ETFs will easily give you around 12 to 14% return. Better than inflation. So yes, and you can sell ETFs any point of time. You can buy ETFs any point of time. These are just like shares. Nifty B is a share. It is a mutual fund. You can say it just like a mutual fund who is registered in stock exchange. So ETFs is also a good way of investment, especially in indices. So we have learned two ways till now, three ways. Mutual fund, but mutual fund will come with some kind of, you can say, expense ratios that we are going to discuss. Means you have to pay some expenses, you have to bear some expenses. So returns may not be that high. ETFs will definitely give you more returns, and it is less riskier, guys. Returns may be around 12%, better than FD, better than FD, I'm saying, huh? And better than your bank saving accounts, better than that, better than PPF, your better than your FDs and RDs, but not as better as individual stocks. Third way of investment was you can buy individual stocks. It is much better. It can give you 40, 50, sometimes even touch 100% return as well. Now coming FNO, most riskiest things. This is a separate topic itself, future and options. So you can invest in Nifty options. So derivatives, derivative is the best way of making money, but this is not investment. This is a trading part basically. Future options is not an investment tool, it's a hedging tool that we are going to discuss what hedging is. Hedging is just, you are trading something, you're protecting your portfolio against. So one thing over here, one important thing in future options and derivatives is that you make money when the markets are going up and you make money when the markets are going down as well. Both ways you can make profits. That we are going to discuss in the coming classes. But till now, we discussed what are the ways of investing in indices, mutual funds. You can invest in index mutual fund, right? You can invest in ETFs. So best ETF is over here is Nifty Bees. So it is an ETF. Anyone can invest, less risky, and you can easily make 12 to 14% return. And next is you can buy directly individual shares of these toppers of the class, toppers of the country. These are top performing companies of the country. Now, guys, the thing is that you might have seen Shark Tank India. It's a very famous episode, very famous TV serial. People come, they pitch, and the big businessmen, as I told you, they give some money. So that money is given under you know given by two ways. Number one, debt. They say, okay, I'll give you debt of 1 lakh rupee at the interest rate of 12%. That is loan, but this is not bank loan. This is individual loan, personal loan, debt. right? This is one way. Second way, that is private equity. This is private equity. You are not going to public this time. As I told you in the previous discussions, that in primary market, a businessman goes to public just like politicians, folding their hands, please give us some money, we need money, trust us, and we'll make your money, we'll double your money, like that. And people give one rupee, 150 crore people, if all of them give 1 rupee each, I will be sitting at the purpose of 150 crore. Now, same case will happen, but here you are going to an individual person like Mr. Ambani, like Mr. like Aditya, like build a group. You go to these people, ask money, and they'll give you. This is private equity. Now you are not going to public, you are going to these people. The concepts will be just the same, but over here two things will come. What there are two types of the shares are divided further into categories: normal share and preference shares. So as I told you that you can go to public or you can go to individual angel investors, you can say, right? And you can raise money from them. And this money is your money until and unless that individual investor withdraws it back. They have the right to withdraw it back, but it's not a legal thing that they can withdraw, because you can, if you don't have the money to pay back, that means in equity, this is the only best thing that you can do. You can raise money without having any obligation to return it back. Though there are multiple terms and conditions, but only thing over here is that you don't have the obligation to return it back immediately, as it is in the loan. Loans, you have to pay back the money. Now, what do you mean by normal share and preference shares? Now, guys, preference shares, some special preference is given. In normal shares, the preference is not given. English term, I'm saying. Just remember this thing. Preference share, what preference would be given? As I told you, in equity, guys, the only positive thing about equity and the best thing about equity, that you not need to return the money back. For example, you are my students. I take money from you in loan, in terms of loan. I have to return that loan back to you. But if I take the money from you against equity, I need not to give your money back. There are few exceptions, but generally I need not to give your money back. Now, this is normal shareholding. When you have, I don't have the obligation to give your money back. But you might ask, then sir, what is our benefit? Your benefit is that you will be getting ownership in my company. So if today you buy 50% shares of my company, you are 50% partner. Now, if you are my partner, guys, you have the voting right. Voting right means, now you took 50% shareholding of mine, I am having 50%. Now I can't take and I can't make decisions for my company straight. I need to ask you. I need your approvals. And only if you approve, on if the majority approves, means you and me together becomes a majority. If the majority approves, only then the decisions are taken. First power that you will get. Second power that you will get is that you are equal partner in my profits. If I am making profits, you will be also making profits. You are a partner in my company. The thing is that over here, in normal shares, you get voting rights for the decisions of the company. You can vote. That is important. And being a fund, being a business owner, I took money from you. I'm not obliged to give it back. There are, criteria which I have, you comes at the last. If whenever if my company is not doing good, it's getting liquidated. First the creditors, then the loans, bank loans. Only then at the end, it will be you that I have to return your money back. And if you are at the last, I may not return your money back to you. So I hope this is clear to everybody. And you get dividends. I told you that I will share the profits with you. So that you will get. So you are getting voting right, you are getting, you can say, profit sharing of my company. And what I am getting being a businessman, I may not need to return your money. I can keep your money as much time as I like. Preference share, on contrary, I told you a preference is given. What preference is given? That I have to return your money back. If my company is getting liquidated, I have to give preference that I have to give your money back. So guys, preference shares have characteristics similar to bonds. Just remember this term. This is very important and very tricky. Preference shares have some characteristics similar to bond. I hope all of you remember what was bond. Bond was I took money from you with a promise. Bond is a promise, promissory note. In my note, I will write that I, Pranivas, will return your money back after 1 year. I have to return it back. This is a bond, obligation, right? Second, after 1 year, I will not return just the money, just the principal amount. I will give some interest on you. So if you gave 1 crore rupee today to me in terms of bonds, so after 1 year, I may have to return 1 crore 10 lakh, 1 crore 7 lakh, 7 lakh extra I have to pay. So preference share, no dividend, no profit sharing would be done. You will get the preference on the liquidation that I am obliged that I have to give your money back to you. Even if my company is making losses, I have to, it's just like a loan, I have to repay it, right? Second, in preference, you will not get the profit sharing, you will not get the voting right. Means if any decision I have to make, I can make this decision on my own. I don't need to, I need not to ask from you. It's not a complete ownership. It is just you are investor and I have to give your money back after a specific period of time with some extra. Means that extra could be there, could not be there, but it is just like having a characteristics of bond. I have to give some interest on that. That this much amount of money I will be giving to you. So these are basically private placement shares. Means it is given on the personal level. It is not dealt in stock exchange. Means I can't buy preference shares of Reliance. I can't buy preference shares of TCS. These preference shares are private equities. Private equities means given on the personal level. Means you can give it to your friend, to your family member, people whom you know, whom you can face to face meet. Normal shares in secondary market, anyone can do it, right? So preference shares can be redeemed just like bonds. You can go and you can take your money back any point of time the way you want, right? So preference shares have similarity with bonds. Normal shares, they are just ownerships which are given to the people or individually as well it can be given. I hope this is clear to everybody. Now, why we should invest in stock market? Means what is the benefit of investing in stock market? The most important benefit is inflation, guys. In previous chapters, we had discussed this thing that wherever, whatsoever amount we are investing, our returns should always be more than inflation rate. Let's take example of today. Today's example, inflation is 7%. So our returns on investment should always be more than 7%. If they are less than 7%, it means our money is getting degraded. In bank saving account, we are getting 2% return. Less than 7%. Inflation is 7%. Bank is giving us 2% return. So guys, the thing is that 5% there is a loss for you. Money is getting degraded, depreciated. You will not get the, your money may be growing, that you think that your money is growing in the bank, but as the purchasing power of the money is getting decreased. So if today you are having 1 lakh rupee, the real value of that 1 lakh rupee after 7 years would be very, very low. It would be around 25,000. So you can only buy 25,000 stuff, though your money will be very high, but the real value, real purchasing power of money will be low. So in stock market, what amount of returns you can invest? Number one, if you are investing in mutual fund, you can easily expect 14 to 20%. If you are investing in ETFs, you can expect 12% return easily. If you are investing in uh, individual stocks, you can expect around 20% and more than 20% as well. It could be 30, 40, 50, 100, 200, 500% as well, depending how you are shortlisting the share, right? Next, power of compounding, guys. It is very important, and you might have seen so many videos on YouTube. More duration your money will stay in the investment tool, means in any investment security. It will compound and it will make your money really grow very, very fast. So please, it is very important to stay, to keep holding on your investment for a long period of time. Don't just keep buying and selling every day, every week, every month. That will cost you taxes and that will cost you, you can say, brokerage fees for the brokers. Stay there for at least 5, 10 years, minimum 5 years at least. Any small company, you can say not a topper student of the class, a normal performing company will also give you positive returns. All you have to do, just stay. And stock market, yes, it can create wealth over the passage of time. And if you can buy good amount of shares, you are getting ownerships in the company. You can transfer this shareholding to your children. You can transfer this share to your wife as well. It's not that it's your share and with passage of time, these shares will expire. This is your money and you can transfer these shares to another people as well. So investing in stock market after COVID crisis have really increased. And guys, investing in stock market in long run, yes, definitely it can make good return to you. Definitely more than inflation rate. Now, key some extra earnings, that we can make if we invest our money in stock market. Can we make some extra earnings? Absolutely. One is capital gain, means today you purchase Reliance share at 100 rupee. Tomorrow that Reliance share, after 1 year it becomes 200 rupee. Again 100 rupee will be a profit. That is capital gain. There is one more gain, that is dividends and bonuses. Guys, I told you now, when you are buying a share, a normal share in a company, you are becoming owner of that company, a partner in that company. Now, if you are my partner in business, you are my partner in profits as well. So, the companies, when they make profits, they divide the profits amongst the shareholders. So, they give money to the shareholders. For example, today I make 100 rupee and I have 100 rupee profit, I'm saying, not revenue. 100 rupee was my profit. And I'm really happy that, you know, let's come to the story again. I took money from you. You were 100 people, and I came to you, uh, that I need money. Please give me some money. I want to start a business. Folding my hands, requesting, and you helped me at that point of time. Now today I am a big businessman. I made insane amount of profits. Now, you helped me when I was not having money. Now I will divide that profit amongst you because you were my helping people. You were the people who helped me, right? So I will divide my profit to you and I will give the profits. I will share my profits with you. So this is called as dividend. So I will share one rupee to all of you that, all you helped me. So I will also share my profit. So this is dividend, guys. So many companies, when they make thousand and thousand crores of profits, they divide that and they give these, they divide that profits amongst the people and they give as dividends. So many PSUs, they give dividends. But this is not the motivation for investment, but this is some extra which you can make. Means not insane amount of money, but some extra amount of money that you can make from dividends. Always remember dividends are from profits. Now, next is bonus shares. Sometimes what companies will do, instead of giving you money, and this dividend money is credited in your account, guys. You don't have to go anywhere for these dividends. This dividend will be credited in your account, in your bank account automatically. For example, sometimes 200 rupee, 500, depending upon how many shares you are having. So if you are having good amount of investments like 25 lakhs, 30 lakhs, 50 lakhs, 1 crore rupee investment, then your dividends can also touch 1 lakh, 2 lakh rupee as well per month. This is also, it can also become an earnings. And PSU, government PSUs are very renowned for these dividends. We are going to do in the case study how PSUs are not a good investment tool in terms of capital market, but for dividend markets, but for dividends. But if I say today, profits are shared by dividends. One more way of sharing the profit is giving a bonus. This time, I am a company owner. I thought instead of giving dividends to you, instead of giving money directly to you, I should give some extra shares to you. So I can divide the profit amongst the shareholders in terms of dividends and in terms of some bonus shares as well. Bonus, you might have heard Diwali bonus, yearly bonus, quarterly bonus, something extra, gift from my side. So again, I will be giving it in the terms of bonus. Sometimes you get a stock split as well. Stock split, what exactly happens? For example, today MRF tires, it is the price of the share is 1 lakh rupee, for example. It is very difficult for a normal person like you and me to buy multiple shares of MRF. But Reliance is just costing me 2000. So in 1 lakh rupee, I can buy one share of MRF or I can buy multiple shares of Reliance. So that is a benefit. So sometimes what happens, companies split their shares. They divide and they break it. So if, for example, if MRF thinks of breaking it down, splits, so if it splits into two halves, so 1 lakh will be divided into two, 50,000, 50,000. Now, from one share costing 1 lakh, now it will At the 1 lakh, I can buy 2 shares. So these are the divisions of the shares. So if I keep my shares for long period of time, so if someone had purchased uh, shares of Infosys uh, in 1990s, and this is a homework for you as well. Please explore this thing. Take it as an activity. A person who purchased Infosys shares, 100 shares of Infosys in 1990, today that person would be holding thousands of shares with him, thousands of shares because of stock split, guys. And this is your activity, this is your homework. Please check it out. How many times stock split has been given by Infosys, and how many, what is the number of those 100 shares in 1990? What would be the present number of those shares? Insane, guys. That person is would be really happy. So you get stock splits as well. All right. I hope this is clear to everybody. Now, ways to invest in stock market, guys. So the ways to invest in stock market is you can do intraday trading, uh, not advisable, but whenever swing comes, whenever some news, macroeconomic activity is coming, some fiscal policy, monetary policy change is taking place, definitely you can do. You can make money, but it's not a regular thing. Please try to avoid. Yes, you can make money, but occasionally, not always. It's not an everyday thing. You can buy stocks for investment purposes for long duration of time. Means you can buy a share and you can keep holding that share for 5 years, 10 years, 20 years. It will give you money. It will give you returns. You can do buy today, sell tomorrow as well. Means I am buying shares, I am paying the money, and I can sell that share tomorrow, day after tomorrow, next week, or next month after making good profits. One way of investing. You can invest in mutual funds. Again, mutual fund we are going to discuss, but mutual fund is also a good source of investing in because when you are so busy, you don't have the knowledge. Instead of buying direct stocks, buy mutual funds. Much better option, much easy options for you. Next is buy ETFs. Easiest way, 12% return, no tensions at all. Whenever the markets are low, buy ETFs. ETFs will save your expenses, your exit ratio, exit loads as well, because in mutual fund you have to pay some expenses, there's some compensation you have to pay for the mutual funds. In ETFs, you are free from these things. So ETFs are also good for investments. And if not investing, if you're going for trading part, future and options are also good, and derivatives are also good. So that can also help you in that way. Apart from this, IPOs are also very, very good, guys. For an example, in 1 year you apply, in every month you apply 5 6 IPOs, and in 1 year you get allotment of 4 or 5 IPOs at the rate of 40 50%. Guys, it's a good win, it's a win-win situation. In 1 year you get allotment of 4 or 5 IPOs at the rate of 40%. It is much much better than FDs, RDs, PPFs and bank accounts. So IPO investment, from my perspective, I had done a video on IPO as well, very practical video, please see that video as well. IPO investment is again one of, it is having less risk, chances of investments are more, and tech research part is also very, very less hectic. Otherwise, equity research is too hectic. It takes a lot of time. IPO research is very easy, guys, not difficult at all. And it is a good way, sure short way of making good returns. Just luck comes into play because it's a lottery system. I hope this is clear to everybody. Now, being a student, how to, and being a professional, how to start investing. I would first request and insist that you should start learning first. Spend 1 2 years in learning only. Do paper trading or virtual trading or virtual investment. By doing this, you will not be losing the money, right? Then once you seem, it seems like you are having good hold on knowledge. Once you have that good courses, master classes, then start an account. Start from small because we don't have to rush, guys. And once you see, it seems like you are good at equity research, you are good at analyzing macroeconomics things, microeconomics things, fundamentals, technicals, for financial modeling is also good. Then you can start investing more and more money. So this is how you can learn fast. And applying in IPO, again, it's a very small step. Only 4 or 5 steps are required. So easy way. ETFs and IPOs and mutual funds. Easy way of entering into equity market. If you don't want to directly enter into stocks, right? So you can do this thing as well. Now, what are the risks which are involved, guys? There are two types of growth in stock market. Growth number one is real growth, which is dependent upon the growth of the company and growth of the country, both. It is a slow step process, means it takes 5 years, 10 years. This is number one. This growth is a good growth. You have to see the macroeconomic things and how the GDP of the country is performing. Growth number two is a bubble growth. Emotions growth means immediately if the money supply starts flowing in, FIIs and DIIs start infusing money in stock market. The prices of the stock market will get inflated, but that will be a bubble, guys. That can burst any point of time. So you have to see which kind of growth it is. And bubble growth will be immediate, will be spontaneous, means in 1 month, 1 week, sometimes 2 months to 1 quarter. Whereas the real growth would take some years. So the thing is that you have to analyze why the stock market prices are going inflated. For that, we need to do some fundamental research. So it is a very volatile market. You have to see what kind of growth and what kind of activities are taking place in the entire macroeconomic level things. Again, it is an emotional decision as well because growth in secondary market, people behave on emotional basis as well. It is just like demand and supply. Consumer, how the consumer emotions are behaving, the people will invest like that. So you have to see how the emotions of the country is going, in which direction they are going on. And definitely you should learn. Investing without research, asking someone, seeing YouTube video, not advisable. It takes a lot of grilling, intense, uh, intense research, intense knowledge to get into this, guys. So it is very important. And guys, don't overestimate things. It is very, very liquid. You will get better returns than FT, definitely better returns than FT and bank saving accounts. You will earn dividends as well. You will earn stocks as well in bonus. You will your stocks number of stocks will also increase because of stock splits as well. So you will be participating in terms of growth of the country, and you are also a owner of a company as well. Just avoid over trading, just avoid following people blindly. Just avoid advices of people and just avoid not learning. Please learn every day, guys. So conclusion is that guys, equity market is a good tool for investments and we need to learn a lot on equity markets. For that, we are going to do equity research series as well. Learn fast, learn early so that you can start investing at very early age because compounding will take place.